For generations, the dream for any big company was to go public, ring that bell on Wall Street. But what if that dream is, well, kind of dying? Today, we're going to dig into why the IPO is losing its shine.
For decades, the initial public offering, the IPO, was it. It was the graduation ceremony for a business. It wasn't just about the money, It was this huge signal to the world that you had finally truly made it. But that's all changing, and it's changing fast. Look at some of the biggest names out there today. We're talking giants like Stripe and SpaceX. They're choosing to stay private. It's not an accident, it's by design. And this chart really tells the story. The numbers are just staggering. Back in 1996, there were over 8,000 publicly traded companies in the US. Today, that number's been cut in half. We're down to around 4,000. So what gives? What is behind this massive shift? Okay, let's dive in and really investigate the case of the missing IPO. All right, the first part of the answer is pretty simple. It's just gotten way harder, a lot more expensive, and honestly, more of a pain to step into the public spotlight. And you can see it right here in how long companies are waiting. Back in the 90s, the typical company was about 8 to 10 years old when it went public. Fast forward to today, and that median age has jumped all the way to 14 years. They are waiting way, way longer to take that leap. And this hesitation, it really boils down to two big things: the massive, ever-growing financial costs, and the intense, non-stop pressure of public scrutiny that comes with having your stock on an exchange. Let's talk money first. We are talking about an average of $4 million just to get a company public. That's for the bankers, the lawyers, the accountants, the whole show. But here's the kicker. That's just the entry fee. Exactly. As Chris Lustrino points out, that initial cost is literally just the beginning. The real drain is staying public. You've got quarterly earnings reports, constant legal bills, whole departments just for compliance. The administrative burden, as he says, is absolutely massive. And then there's the scrutiny. Wyatt Cavalier just nails it with the Elon Musk example. Think about it. With his one public company, Tesla, every single tweet, every move is picked apart. But with his private companies like SpaceX or XAI, he's got the freedom to pretty much do whatever he wants without that constant judgment. Okay, but the hassles of being public, that's only half the story. The biggest reason IPOs are losing their appeal is because of this explosive growth of a really powerful and much quieter alternative. Researcher Brian Flaherty calls this a shadow market, and that's the perfect description. It's this whole other ecosystem that's popped up where founders, employees, and early investors can get liquid. They can cash out their shares without ever needing a public stock exchange. So how does this whole shadow market work? Well, it's basically built on three key pillars. First, you've got these secondary platforms. Think Forge or Hive, which are like marketplaces for private shares. Then, you have new funds that step in to provide the cash. And finally, you have pro brokers who play matchmaker, connecting the buyers and sellers. And what this all represents is a huge cultural shift. Christine Healy puts it perfectly. The old taboo around selling your private shares early, it's just lifting. It's no longer seen as a sign of weakness. It's now just a standard, smart tool for investors. This new world is even pushing into wild new territory, like tokenizing equity. And it's a real debate. On one side, you have skeptics like Chris Lustrino who kind of see it as just another security that attracts, grifters. But on the other hand, you have visionaries like Brian Flaherty who see this as the future, where basically any company can create its own little stock exchange. So this brings us to a really crucial question. In this new world where private markets are becoming king, who is actually winning and who might be getting left behind? So who are the big winners here? Well, Wyatt Cavalier is pretty clear about it. The main beneficiaries are the insiders. We're talking about the VCs who can now show returns to their own investors, and of course, the founders and early employees who get to cash out. And the retail investors buying these shares? Well, they're often an afterthought. In fact, Brian Flaherty takes this idea a step further with this really provocative theory. He suggests the IPO could totally transform from being a graduation ceremony into what he calls a salvage operation, basically the last-ditch effort for a company that couldn't sell itself anywhere else. He poses a really critical question for anyone investing in the future.
If a company had all these private options to get cash, a secondary sale, a merger, an acquisition, but it decided not to take them, well, then you have to ask yourself, why did it IPO? It could actually be a massive red flag. All right, let's move into our final section and look at how all of this could be building towards a totally different future for what it even means to be a public company. Here's a fascinating possibility. What if the entire purpose of an IPO flips on its head? Instead of being a way for a company to raise money, what if governments start forcing systemically important companies, like an OpenAI, to go public, not for cash, but purely for transparency and accountability?
And Brian Flaherty uses Twitter as the perfect example to make this point. Remember when it was public? There was this sense that it was accountable to the public square. Now that it's private, well, that idea is a lot more questionable, right? Being public forces a level of transparency that private ownership just doesn't. But we're gonna end on one last really provocative thought. What if the wall between the public and private markets doesn't get knocked down by some new law, but by simple economics? See, right now, to play in these private markets, you have to be an accredited investor. Basically, you need a high income or net worth. But here's the thing, those dollar amounts almost never get updated. So if inflation keeps doing its thing year after year, more and more of us are eventually going to qualify. Access to the private markets could stop being a privilege for the super rich and just become the new normal for everyone. The question might not be if you'll invest in private companies, but simply when.